Interest rates have been rising. That's no surprise. And did you know they actually affect the cash value of your life insurance policy? So stay here for the next few minutes while we cover how interest rates really work. Okay, so let's just get right to it, right? Interest rates affect banks more than insurance companies. Why? They move faster. You've already seen it. Every time the feds keep raising the rates, and they've been raising them every 6 weeks, they've been going up like a 0.75%, right? Now your savings account, you haven't noticed much change there as much as you have like on credit cards. You've been seeing it go up on car loans or mortgage rates. Those have been going crazy, right? We've been seeing that go just skyrocketing upward. Well, how does that affect insurance companies? It doesn't, not at least not in the short term. It takes a long time to do that. So again, banks are much quicker to adjust to it, where insurance companies are this very slow moving barge. All right, now first, let's just talk about what are the interest rates inside of a life insurance company, right? How do you earn those dividends? Where's that money coming from? Because many people think, okay, am I just earning this like a bank normally pays me? They just fixed a rate and say, here. Well, there's some truth to that because they do set the dividend rate the year before, usually right around Thanksgiving time. The companies will say, hey, great year, we made money. Here's the rate for next year. And so they even tell you what they're gonna pay you the following calendar year. So if this is, if you're watching this in 2023, right? They're gonna say, great, Thanksgiving 2023, 2024, this is what the rates are gonna be like. No mystery, doesn't change in mid-year at all. It's pretty much the same. It's kind of boring actually. It's not as exciting as watching the news. Definitely not as exciting as watching Fox News or MSNBC or any of those other people, right? It's pretty slow. Now, to understand this, dividends actually are paid from 3 different sources. 2 for the most part, 3 depending if it's a mutual company. And I'll get to describe what that is. So there's 3 things that contribute to your dividend each year. 1, there's a return of your premium. So insurance companies already allocate, they already kind of budget in, they're gonna return part of your premium payment back to you each year. Now someone will say, oh, that just means I overpay. Well, it's true, you do, because insurance companies have learned from the last Great Depression, remember, only 4 insurance companies went out of business in the Great Depression, while 50% of banks, half of banks failed during that period of time. So they learned to be very conservative in how they do their numbers. So what do? They plan for possible catastrophic situations, even more catastrophic than a 9/11 type of scenario, right? Something that could just kill maybe hundreds of thousands of people. They budget that in to their insurance numbers. Now, of course, the year passes on, and this is even true in 2020, nothing crazy happened with deaths like people were wondering would happen. They said, great, nothing out of what normally happened, we're gonna pay that percentage of money back. That's why they can usually guarantee at least 3 or 4%. That's why that's usually the minimum kind of guarantee you see. Now, there's also another way they make money. They have an investment portfolio. So all that extra cash that you have, they are investing it. Now they're not lending it out, like lending out more than they have. They're not like the banks where they get risky that way. They're primarily investing in things like mortgage-backed securities. That's one of the most crazy stuff they do. Usually they're buying bonds or treasuries, things that are really just kind of boring investments, don't really make a lot of money. But to the point of this video, they are affected by interest rates. So the bonds that they usually buy longer term bonds. When the old bonds sell off, then they buy new ones. Now what we've seen is that over the years, insurance companies have actually dropped their dividend rates because interest rates have come down. So they've been dropping. If you go back even just 25 years, you'll actually see that many of the insurance companies' dividend rates were right around something like 9-10% or more. So you actually saw sometimes double-digit returns in their dividend rates because interest rates were higher. But as they've come down over the years, it's also brought the rates down. This is why typically the good companies you'll see about a 5 to 6% dividend rate. That's typically what you get. Now there's a third way. I mentioned the first was return of premium. Second was their investments that they're doing, like buying bonds. The third are company profits, if it's a mutual company. So have you ever heard of companies like Guardian, Mass Mutual, Penn Mutual? You ever hear companies like that? Even New York Life or Northwestern? Those are mutual companies. Now, mutual companies are similar to a credit union. You know how if you go to a bank, banks have shareholders, so when they pay their extra profits, the interest rates, they usually pay it to their shareholders. Well, a credit union will pay usually higher savings rates on your savings accounts because the members of the credit union, which are you, the people that put their money in, are kind of like the owners, right? You're kind of like the people involved in the decision-making process. That's the way they send you letters and you're like, I don't care who gets elected. I don't even know who these people are, right? That's what that is. Same thing happens with insurance companies. Like the credit union will pay you a little bit more interest because they don't pay all their profits to a stock shareholder, they get paid back to you. So a mutual company is generally a better type of company to use when you're getting life insurance, because now you not only have that return of premium and investment performance, but now you also have profits from the company. So the more profitable the company, the more money you make as well. So those are the three ways that you earn interest from those dividends. Now, like I said, they have an investment portfolio, they're buying bonds and treasuries and stuff. Because of that, they are swayed by interest rates, but they are longer term ones. So let's just say, for example, that they're buying 12-year bonds. That means if you're in 2023, that means they're buying bonds. They had just sold off their bonds from just back in 2011, right? Now, 2011, we know that interest rates kind of came down quite a bit, especially after the recession. They bottomed out those rates pretty dang low. Well, if they're buying higher rates in 2023, now what happens is that each year, if you start selling off the cheap ones and buying higher interest rate ones, that starts to drive the performance of their portfolio up. What does that do? That means your dividends will eventually go up. So I have bad news for you. The bad news is that as interest rates go up, insurance companies are very slow to respond, right? Because it takes time for that portfolio to sell off the old and bring in the new at higher rates. So the bad news is it's slow moving. The good news is it's slow moving, because the same thing happens, the opposite. If rates tank again, you can still be getting paid much higher dividend rates for longer than what the banks will be doing, where they go down very, very quickly. You get a better return as a result. So it's like a barge moving. It's not like a speedboat, right? The banks might be like speedboats. They can adjust and turn and move. But when it comes to insurance companies, they turn very slowly, right? They tend to slow a little bit more. So what that means is, like I started talking to the insurance companies saying, what about 2023 dividends? What are you gonna tell me of the future? They said, you know what? Yeah, we are buying better bonds, but it's not quite enough to move the needle. We're probably gonna keep dividends about the same, Now they even said the loan rates, because many people ask us about the loan rates on it. The nice thing is that the loan rates, if you decide to borrow money to use in other places, the loan rates don't go up or down a lot either. They're not based on the prime rates from all the feds making their decisions, right? They're based on the dividends. So if dividends go up significantly, they'll raise the loan rate. If it goes down significantly, they'll lower the loan rate. So loans tend to follow. If you get some good companies, like I like certain companies that are more stable, you'll notice that in the last 15 years, they have hardly moved anything. The dividends have been very consistent. They've been within a certain very tight range, and the loan rates have been almost the same across the board. Very easy to be able to create predictions. Very easy to make it work for you. Speaking of predictions, so what does that mean? 2023, dividends have been about the same. Now 2024, however, if interest rates stay up higher, and if they do keep going up into the future, who knows? The feds might keep raising rates well beyond where they are right now. If that's the case, that's good news for you if you have a life insurance policy, because what that's doing is it's going to drive those dividend rates up, so that by 2024 especially, you'll probably start to see a difference. And even if they start crashing the rates, say that they start crashing the rates in 2024, great. Well, guess what? They've already moved the needle. That means those bond performances and everything goes up. It's longer term, so that life insurance will start paying more even when banks are paying less. So I personally believe that dividends will be on the rise again. In fact, you look at history, this is some of the lowest dividends we've seen in decades. Where we see companies paying between like 5 and 6%. Some of them really low, like around 4. That's horrible. But generally between 5 and 6%, that's pretty typical. I think we're going to start seeing dividends get up well above 6% or 7% like it was 15 plus years ago when I started looking into whole life insurance for the very first time. So that's how these things work, right? They really work based on the slow moving interest rates and how they do in the performance, but as well as the company profits. If the company's wise with their money, you make more money. So guys, that's what it is. That's how these things work. Hey, put in the comments, what are you seeing right now? Are you seeing rates on the rise with your insurance policy? Go ahead and like this video, comment below, and check out this next video, how to achieve financial independence and retire early, but only if you want to retire early. If you want to work forever, don't watch this video.